Hello, today I'm going to be looking at the current tax computation, and I'm going to try and give you a nice systematic approach to doing this current tax comp. We're not going to deal with every single complexity that can arise, but once again, the big overriding systematic approach that you will need to apply is going to be discussed. So the starting point, we're going to take our accounting, and the accounting figure that I'm interested in as a starting point is profit before tax. So whatever that figure is in your statement of profit and loss and other comprehensive income, you're going to put that down. Then I want you to adjust for all items that will result in the tax expense being an effective tax rate that's different to the standard rate of 28%. So the first couple of things we will look at, we will call permanent differences. And these permanent differences will be items of income and expense that will either never be taxable in terms of income or never be deductible for tax purposes in terms of expenses. So the first one we'll reverse out is all non-taxable incomes. And some examples of those would be your dividend income, etc. So non-taxable income, I reverse out by deducting it, reversing it out of profit before tax. The next one is my non-deductible expenses. Now, non-deductible expenses will be things such as some donations are not deductible, fines on late payment of money to the tax authorities. Also here, if you have if you have depreciation for accounting purposes on an admin building, but that admin building never gets a tax allowance, then that would also be a permanent type difference, a non-deductible expense. How do I reverse that? I add it back to profit before tax. What I'm also going to ask you to do is take out all foreign income that is not taxed under South African tax law. You're going to reverse that income, subtract. The last one is also your accounting profits above cost. So accounting profit above cost, you will reverse out in total. And here you're going to go and do a separate capital gains tax calc to work out the taxable capital gain. So the accounting profit above cost. Now this methodology is slightly different when it comes to accounting for the capital gains issues across universities. We're going to give you a systematic approach that will work in every single scenario for every type of capital transaction. So you're then going to have a little sub addition, and below that I'm going to ask you to adjust all your movements in temporary differences. Now, these movements in temporary differences we will deal with in more detail in the next couple of lectures, but the most common one that I'm just going to use here is going to be the difference between accounting depreciation, and we'll reverse that accounting effect of the accounting depreciation. So to reverse out that expense, I'd add it back. And I'm going to say to you that we are going to then get a tax allowance or wear and tear per the Income Tax Act that will be given as a tax deduction. There's a whole bunch of these. Just going to stick to the basic depreciation wear and tear for this overall example. Now that difference could either be a positive or a negative. If it's a positive, we're going to call that a taxable temporary difference. If we call it a negative, we're going to use that word as a deductible temporary difference. The next thing is this accounting capital profit that you worked with on top, that went off and you had to go and do a CGT calc, which we do with you later. And the effect of that capital profit then gets brought in terms of your taxable capital gain. And you'll bring back in your taxable capital gain that will be either a positive or a zero. You can never have a taxable capital loss being brought into your current tax comp. Why? Because the capital losses are ring-fenced and can only be offset against future taxable capital profits. Okay, so I bring in my taxable capital gain, and let's assume that I have a tax profit there. At that point, if I have a tax profit, I would times that by 28% and I'll get my current tax expense. But we might also have a scenario where I have a tax loss. If I have a tax loss, I also must remember I might have a tax loss or an assessed loss brought forward from last year. So let's call that prior year, and I use BF to show brought forward. Now, what happens with tax losses? In terms of the Income Tax Act, the tax authority does not give you a big check back if you run into a loss, as it does to individuals. But what it does do is the tax authority says you can carry tax losses forward to reduce future income in future periods. So if I had an assessed loss in the prior year, I would then bring that assessed loss as a deduction forward into the current year. And that would either reduce my tax profit or make my current tax loss even bigger. So once again, it could be a positive or a negative. If it's a positive, then I would go straight down to taxable income, and I would have a total taxable income figure. But if it was a tax loss, then that loss gets carried forward as discussed, and I would have an assessed loss carried forward. And that would be a current year carried forward, and that will be utilized in future periods to reduce future taxable income. So if that was the case, I would have a 0 taxable income and 0 current tax expense. Now, from here, I want you to understand that you could do a couple of journals. The first journal that you would look at doing, I'm just going to label that A. That first journal would be a current tax expense, which would be debit my current tax expense in profit and loss. Please let's get into the habit of mapping our accounts correctly, and then we'll credit the current tax liability and that is a financial position account. Remember, I would take whatever A was and times it by 28%. And that would be my current tax journal. In terms of my assessed losses, the assessed loss in the current year, let's term that journal B. Again, I would times that by 28%, but an assessed loss in the current year means that I have a future tax deduction, namely a future economic benefit, and that would give rise to a deferred tax asset. So deferred tax in financial position. The credit would go through deferred tax expense in profit and loss. Once again, we would times all of the amounts by 28% to get the tax expense effect. Now in the following year, when I bring forward that tax deduction and utilize it in the current year, then I have to reverse out that economic benefit because I'm utilizing it. So therefore I would go and for journal C, the deferred tax prior year assessed loss brought forward, I would go debit deferred tax, profit and loss, and I would have a credit deferred tax, financial position, because I'm utilizing the asset. How do I use up an asset? I credit it. Once again, please, this is times by 28%. I'm recording the tax effect on the assessed losses. The last journal, which ideally I should not be doing from the current tax comp. I should ideally be doing this journal, or this proof, let's call it, from the deferred tax financial position account. So this item D, let's call this the proof of the deferred tax movement. And if it's a positive, okay, so a positive net amount on top of that block there, then I would have a taxable temporary difference being debit deferred tax, profit and loss, credit deferred tax, financial position. And that would be a deferred tax liability movement. Remember, that's associated with a taxable temporary difference. If it was a negative, then I would have a deductible temporary difference, which means I would have a debit to deferred tax financial position, credit deferred tax, profit and loss. I would be raising an asset. Great, I hope this has helped. I need you to please learn this format so that we can apply it as we're going through in the more advanced lectures. It's going to be very, very important going forward. Thank you.